This chart tracks the value of the Indian rupee against the US dollar, highlighting a sudden collapse that ends here, at a record low of 96.96. That specific drop is a direct reaction to heavy turbulence overseas. Escalating geopolitical tensions are creating intense, sustained volatility across global energy markets. This external chaos hits India directly because the country is one of the world's largest importers of crude oil. They require massive physical shipments of fuel to keep their domestic economy running. When your national currency loses its value, buying oil priced in dollars becomes more expensive. If those import costs keep climbing, the financial pain passes directly to local businesses and consumers in the form of rising inflation. To stop the currency from weakening further, the Reserve Bank of India, the country's central banking authority, stepped into the foreign exchange markets. Their defense strategy relied on sheer financial force. The central bank began selling roughly $1 billion in foreign reserves every single day to buy up rupees and prop up the currency's value. This diagram illustrates the mechanical trap of that intervention. By constantly intervening to buy local currency, the central bank is physically sucking rupees out of India's commercial banking system. As cash disappears from these banking silos, money becomes scarce. That scarcity causes short-term funding costs to climb, making it increasingly difficult and expensive for domestic businesses to borrow the capital they need to operate. The central bank found itself in a difficult balancing act. They either had to keep draining domestic cash flow to save the rupee, or reduce their currency interventions to save the banking system's liquidity. Policymakers needed a way to immediately inject rupees back into local banks without undoing their efforts to support the currency in the open market. On May 26th, they executed a targeted policy maneuver to solve this problem, a $5 billion rupee swap auction. First, the central bank takes $5 billion from commercial banks, releasing a wave of rupees straight into the local banking system. But the operation is temporary. In exactly 3 years, both parties reverse this exact trade, swapping currencies back to their original owners. This provides the domestic system with the cash needed to keep the economy moving today, while deferring the impact on currency reserves 3 years into the future. The impact of this technical move was immediately visible in the financial markets following the official disclosure of the swap. This tracks the yield on India's benchmark 2035 government bond. Right after the swap announcement, the yield crested and moved lower. For bond traders, this shift signaled the central bank wouldn't allow liquidity conditions to tighten enough to damage the broader financial system. Through this targeted intervention, the RBI managed to calm the domestic bond markets and lower borrowing costs without abandoning its defense of the rupee. While India's operations solved an immediate domestic crisis, it reflects a broader challenge facing central banks across the developing world. Global capital is moving toward higher yielding and perceived safer assets, which increases the pressure on the national currencies of import-dependent emerging markets. Policymakers are now reassessing their monetary trajectories. They are attempting to find ways to stabilize their exchange rates while avoiding more aggressive interest rate tightening that could slow domestic economic growth. Navigating prolonged geopolitical uncertainty and inflation shocks now requires these economies to deploy more targeted financial defenses, prioritizing the stability of the financial system while attempting to maintain growth.